Howdy, Jacob here. Today we're looking at Ecolab in the chemicals industry, 71 billion market cap on 78 billion enterprise value. Quite a bit of net debt here. We are looking at very little growth too, barely up over the last 10 years and kind of went down for a little bit and then back up the last 3 years. Gross margin is down from 10 years ago. Operating margin pretty much the same. So operating margin is pretty solid, that 12 to 15% range. Gross margin not terribly high. Dividend, they do pay a dividend. They've been increasing it every year for the last 10 years at least. It's a 0.9% yield, and it's not super substantial in relation to their earnings. It's not nothing, though, either. So, I mean, it's almost 50% of this year's free cash flow, so it is a good amount, but it's not so much that they can't afford it, I wouldn't say. Return on invested capital, high single digits, so nothing to really brag about, but been around since 1923 out of St. Paul, Minnesota. Hometown, very cool. Operate through 3 segments: global industry, global institutions, specialty, and then global healthcare and life sciences. Okay. So ready to look at income statement. No R&D, heavy, biggest expense, cost of goods sold. Balance sheet has just under $1 billion cash on hand, 630 million short-term debt, 7.5 billion long-term debt. I think that's going to be a lot of debt here. 7.5 billion long-term debt with, I mean, they're probably averaging 1.5. This is going to be their capex. So 1.5 and 7.5. So that's going to be about five times. 5 times their average free cash flow in debt is a good amount. And it looks like they issued a bit of debt here to fund an acquisition, but outside of that, in the last 10 years, they do buy back debt more than they issue it, so that's positive. Their dividend is paying out less than 50% of that 1.5 billion average free cash flow. So it's really just a lot to the dividend, a bit to share repurchases, and then a bit to acquisitions here. That's enough to get me to make some assumptions. Revenue growth, I mean, we just didn't see a lot of growth, but I still think that they will be able to grow with acquisitions and a bit organically. So maybe 4%. Enterprise value is a little higher, but not terribly high. This is more so just because their growth and return on invested capital aren't really that fantastic. And then I'd be looking for 9 and 10 on the margin side. Share repurchases, 700 million is 1%. I mean, maybe half that with their stock-based compensation is reasonable to me. And a dividend that, is only a third right now. Let's increase it with that revenue growth. So with revenue growth and the same margins, it should stick to a roughly 30% payout, 30 to 40% payout. And it looks very expensive to me. I mean, that's interesting. This 40 PE with just a low growth business in my perspective from what I'm seeing. That's just very interesting. So I think the company's fine. I don't think it's anything to brag about, but I think the price is definitely overvalued for me. Hope you enjoyed the video.